Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I am Michael Bull, and I appreciate you being with us. This show is brought to you by C5Summit.Real Estate. Look, the C5 Global Summit. This is a CCIM Global Summit, and it is September 17th to September 19th. It's in Hollywood, Florida, and I've been to these events a few times, and I'm speaking twice at this one in September in Hollywood. So show up. The CCIM is a great organization, and for those of you not familiar with it, it's not all brokers. It's probably 60% principals and developers and sponsors. So come check it out in Hollywood, Florida. The website, again, is C5Summit.Real Estate. Well, speaking of real estate, that's what we're going to talk about today. We're going to talk about investing in real estate in Canada. And you may think, well, Michael, isn't this America's Commercial Real Estate Show? Yes, but I think what we've been seeing is, you might not notice it in the headlines, but there's a lot of investors that are investing in Canada. So let's look at what are some of the opportunities, what's going on, why is it happening, and what should you think about? Well, please welcome my guest. And I have Braiden Goodchild, and he is with PwC, and I have Tim Bodner, he's also with PwC. And they are, in addition to their deals roles, both Braiden and Tim sit on the editorial board of PwC's Global Emerging Trends in Real Estate publication, which we cover here. It's in its 46th year, and it reflects the views and opinions of influential real estate folks on where to invest and develop. So, guys, welcome to the show. Thanks for being with us.
Thanks for having us, Michael.
And first of all, what's going on in Canada? Are there more investors investing in Canada from the U.S. and other countries? And why are they doing it?
Yeah, no, great question. And I think the headline response, Michael, is absolutely. We saw substantial inflows from the U.S. and also global investors last year in 2023, and have continued to see that in 2024. I'll unpack all the reasons of why that is, but I think it is helpful just to kind of level set on the Canadian market kind of relative to the U.S., right? So why are we seeing these substantial inflows? Well, I think there's a lot of characteristics that resonate well with U.S. investors, particularly now. So I think one thing just to level set on is the population economy, right? Very high level. Canadian economy is about the size of Texas, around 2 trillion, and our population's around the size of California, around 40 million. And then the other thing, when folks look at Canada, it's like, wow, that's the second largest landmass in the world from a country perspective. But what's interesting is that 90% of Canadians, live within 150 miles of the U.S. border. So it's actually not as sparse and spread out as you may think. There is actually quite a bit of population density. And I ran some figures through ChatGPT, and if you were to adjust for the 90% of the population living within 150 miles of the U.S. border, Canada actually has higher population density than the U.S. according to ChatGPT. So always take that with a grain of salt. And then I think, sorry, go ahead.
How is the market working there? Because we all know what's going on in the U.S. if folks are listening to this show, but how's performance there?
Yeah, I think performance is mixed, depending on which asset class and where you're playing in the risk return spectrum, whether it's income producing or development. I mean, just to give you a brief sense of where maybe cap rates are here, relative to the U.S. So I think office would be certainly in the 6s to 7s. Multifamily has been by far the most resilient sector in Canada, particularly over this period of relatively rapid interest rate rises that occurred in 2022 and 2023 at 4.5%. And then retail and industrial are kind of somewhere in between there. And, I think, vacancy rates in office are pretty similar to the U.S. Our average vacancy rate in Canada is 19.5%. I mean, averages are indicative at best and misleading at worst, because it's obviously quite a bifurcated situation in terms of Class B commoditized versus Class A plus ESG spec. And then looking at multifamily, sub 2% vacancy rate nationally, very tight market fundamentals, which I can jump into later as well. And retail, depending on the type of retail, I think the average vacancy rate is 8%, but that's going to vary greatly whether you're necessity-based, grocery or anchored, which, you're probably 0 to 2%, versus a community shopping center, which isn't a dominant shopping center. You're going to see obviously elevated vacancy, probably above 8%, but the average there would be around that level. And then industrial, it was incredibly tight here, for similar reasons why it became tight in the U.S. over the pandemic and the rise of e-commerce. But we started to see our availability rate tick up to 3.5%, which still, from traditional metrics is a tight market, but certainly seeing some new spec space lingering longer on the market, and a bit of deceleration in rental growth in that space as well in the market. And certainly, there's a upcoming payment shock risk, which could obviously have some concern to pricing levels in the Canadian market, although they are quite elevated and have been incredibly resilient. And then just turning to the commercial sector. So I think a few things. One, Canada does not have a CMBS market of any significance. So a lot of the stress that happens, we don't necessarily see what's happening behind the curtain because there's no obligations to publicly report. Two, we have basically 5, maybe 6 big banks that do all of the major commercial real estate lending. Now there has been a growing non-bank private lender space, which I'll get into. There's some stress in that space, but largely all of the commercial real estate lending is really provided by our 5 banks versus the U.S., which you tell me, but seems like there's probably thousands of lenders in your neck of the woods. And so really those would be the 2 big changes. And then probably the third, which impacts, I think, how quickly the industry can heal sometimes, is recourse is, I think, a bit more prevalent up here in terms of, not just to the asset, whereas I think, non-recourse lending is maybe a bit more normal course down south, meaning that you can't just hand back the keys if you don't want to reinvest into the property, if, you have significant covenant exposure up to the parents. So I think that kind of does result in maybe a slower churn of product as well.
Great. And the underlying ownership is simple, similar to the U.S. though, just fee simple, warranty deeds, right?
Yeah, it's not so dissimilar. It's fee simple. You're not buying leasehold real estate, and you get kind of good custody of chain of title here.
Yeah. So what about barrier of entry? Is that impact the Canadian market differently than the U.S.?
Well, yeah, barrier of entry is a really excellent point, and why I think, a lot of U.S. investors, I think I can count up to 8 that have set up shop, largely big beast private equity, in addition to developers, is historically Canada was a high barrier to entry market. Why? We have very large super funds that have annuated in Canada. They're called the Maple 8. And, they were very active, particularly when real estate was becoming institutionalized, right, over 2000s and upwards. What's transpired, though, is 2 things. One, the pension funds are largely at their allocation limits, so they're at the ceiling, and that's not being helped by the denominator effect. And so there are capital constrained. And then two, they are in asset classes they may not want to be in, but have historical legacy from, which is largely office and retail. Not to say office and retail isn't part of a diversified portfolio, but certainly some of those, pension fund, super fund portfolios are overweight to the space. And the third thing, just from, investing 101 perspective, is diversification. And a lot of our institutional investors are looking to actually invest outside of Canada rather than in Canada, just because, it doesn't make good doctrine to have, substantial majority of your asset exposure in one country. You don't want all your eggs in one basket, which has left a bit of a vacuum here in terms of the liquidity that was being supplied for those, especially mid to large trades, is no longer as bountiful as it once was. And then you also take into account the REITs, which we have about 40 to 50 REITs in Canada. And we know that their discounted NAVs are, on average, according to analyst NAV, probably 25% off of where, the analysts have marked the NAV today, meaning that, they can't raise equity at an accretive level. It's actually dilutive. So those participants that were buying a lot of the other stock the institutions weren't, are also out of the market. And in addition, they can't take a lot of development risk or they start to run awry of their REIT test. So really, the absence of the institutional investors that are domestic in Canada, and two, just the REITs, which are a bit seized up in the Canadian marketplace at the moment, have presented an opportunity to, realize outsized returns just by nature of the supply and demand of capital.
Yeah, that sounds like a great reason to be looking at investments in Canada. What about barrier of entry for new development? How difficult is it to get new product out of the ground there?
Yeah, so 100%. So development, in Canada right now is largely concentrated around the residential sector, right? So purpose-built rental, condo, and to a lesser extent, purpose-built student accommodation. So what's transpired is, look, we're at an overnight rate of 7.3%. So development financing is 8.5% plus. It used to be 3.5% during the pandemic, when you had an overnight rate of or a prime rate of 2.45%. Your prime plus one lender. So development's become economically more difficult from a feasibility perspective. In addition, Canada has been, a high density residential build market, largely in the condo space or largely in the for sale space for residential. So if you come to Toronto, which we'd love to have you up here, or to Vancouver or even Montreal, which are really kind of the top three kind of gateways in Canada, there's been a significant amount of high density, high rise for sale residential product. But what's happened is, because of the way the financing system works here, you need to pre-sell 60, 70%, sometimes 80% of the units before you can get construction financing. So the bank de-risks their loan. Well, now that prices are no longer going up in Canada in the condo market, that's really slowed down the level of pre-sales, which has really slowed down the delivery of the for sale model for high density residential. Meaning what? Well, now if you can't get your projects launched and you can't get shovels in the ground, and your interest rates have doubled on your land loads, and you've blown through your interest rate reserve, you might start to look at developing these projects in a different way for a different purpose. And this is why purpose-built rental has really rose the top of interest. One, because there is substantial sites available. Two, there are stressed conditions, meaning that you can probably get attractive entry points or recapitalize some challenged capital structures. And three, the government here has been really backing the sector. I mean, we just had our federal budget announcement in April, and there was a significant capital set aside for financing programs, kind of agency lending like you folks would have with Fannie and Freddie, big top up to what the program is called ACLP here, to really try and get more housing supply into the system. Canada is short, millions and millions of units. We're trying to get to 5.8 million units by 2030. And I think we're only on track to deliver 3.5 million or something along that. Don't quote me on these numbers. So we're short, 2 million units. And unfortunately, how we delivered those units historically at scale was through high-rise condos. And though that model has really broken down in terms of development. So we could be at really a golden age of purposeful rental development. And if I look at a lot of the U.S. investors that have moved up here, certainly, they're leaning into that space. In fact, there was some press around, 100 billion plus, U.S. developer investment manager that they've earmarked. I think the article referenced $2 billion more into the Canadian market, given the attractive supply-demand fundamentals, and really this moment in time opportunity where, the capital markets are a bit seized up and there isn't that level of competition, for deals.
How do U.S. developers who come to Canada find the cities, the municipalities, as far as entitlements and getting projects rolling and cost and approvals?
Yeah, well, that's a fantastic question. And, one of the big differences in the Canadian system, which, has the attention of all three levels of government here, federal, provincial, or as you folks would call it, state, and municipal / lower tier, is shortening the development time frame. So it wouldn't be unusual in, at least where I'm situated today, which is Toronto, for start to finish development planning project, if you have to go through kind of zoning and land use activities, for 8 years, which, obviously is a massive cost of, has massive cost of capital, particularly for IRR driven investors. But what we are seeing is government kind of reacting to the severe housing shortage, and recognizing that time matters, particularly in terms of development and the underlying capital. So, for projects that have a larger proportion for affordable housing, which is not necessarily, social housing. There's very defined definitions, and a lot of it is just attainable housing. That can really speed up development timelines. And I was with a developer last week, and they're getting through applications in 12 months. Now, they are a socially conscious impact type of developer, but it's definitely positive to see some movement there, which has understandably been a deterrent from certain U.S. investors who can get projects through in their own jurisdictions in some cases 12 to 24 months.
Yeah, well, that's really interesting. Back to the office market for a second. Yeah, we're all in the U.S. understand what's going on in our office market. How does that compare to the big cities in Canada?
Yeah, I think it's probably broadly similar. I think, as I said at the beginning, we're around 20% national vacancy. Toronto is 18%, but if you bifurcate that between Class A, it's probably closer to 10. And there's some folks who think AAA downtown Toronto office is 6%. And actually, if you look at Vancouver, the vacancy rate there has been declining. And also, there's been some international trades, especially from German investors in that market. Strikes me that the U.S. is probably somewhere in that kind of 18 to 20% range. I think what we are seeing, and I'd be curious if you folks are seeing this as well, growing interest in conversions. Obviously, we know that that's for a very select amount of buildings, but that's seeing some government backing, particularly at the municipal level, in Canada. For instance, city of Calgary, which would be kind of the fourth largest city in Canada, they have a program where if you convert an office building to residential, you'll actually receive a $75 per square foot grant on completion of that building. I think it's called the Downtown Calgary Incentive Plan. So conversions are happening. We'll have to keep abreast of whether that's something that will kind of continue and migrate to other markets. Certainly, the federal government in their budget announcement also indicated that underutilized or surplus lands, that's in the federal stock, will look to be redeveloped into housing as well. And I think there's been some encouraging, return to work announcements. The federal government again, I think it was in last month, they announced that employees will be required to be in the office 3 days a week. And, they are a massive occupier of real estate. And, most of our, corporates, are kind of the 3 days a week model. I don't know about, how it is in Atlanta, but, certainly I was waiting at the bottom of the elevator today to get to our office building for, 5 minutes. So I think that's certainly positive and constructive.
Well, that's interesting because, how you guys participated in COVID, if you can call it that. It was down in Florida during COVID. It's like, what's COVID? We're not participating in that. So in Canada, just people were sent home as well by the government.
Yeah, we, Canadian. I was in London, England when the pandemic first happened. I was working for a UK business, but Canada and certain parts of Canada, particularly Ontario, were shut down for quite a while, to the extent you couldn't even go to golf courses. But certainly now it's a return to normal is in full flight. Entertainment venues are and restaurants and all of that is back to travel as well. Hospitality, we're at pre-pandemic levels of ADRs and increasing RevPAR amounts. So, certainly, hopefully, knock on wood, in the rear view mirror.
Yeah. Well, Tim, you've been kind of quiet there. Chip in here. What are you seeing?
Yeah, I think we've been spending a lot of time talking about, capital going into Canada. I think the other thing that I'm seeing, here from the United States is a lot of interest in U.S. real estate. And what I would say, Michael, is certainly like residential related themes, affordable housing, multifamily, and the like are quite active. But I think one of the other things that we're seeing in particular from Canadian, the pensions, which Braiden mentioned earlier, so the Maple 8 for sure, but also kind of the wider asset management community is kind of a increasing number of sectors that are considered to be investable real estate, some of which were, historically considered to be more infrastructure. And there's kind of this bias towards kind of more of a real assets theme versus just a real estate theme. And so that's getting into, certainly things like data centers are attracting a lot of attention, but I would say it's wider than that, and touched on things like wellness real estate, which I think we might have talked about in some of our prior shows with you, but wellness related real estate, things around experiential related real estate, mixed use development, sports, live entertainment, particularly given kind of the growth in things like women's sports and the like. So I think what's really fascinating to me is that the amount of capital in Canada that's pointed at the U.S. is quite significant. And it's not just those traditional sources, but it's the alternative asset managers that are based in Canada, as well as things like family offices. Braiden and I are working on a number of deals in the family office space that are really significantly focused on the U.S. So it's really quite fascinating to me here sitting in the U.S., just seeing how much different activity there is coming to and from Canada.
Yeah, and Braiden or Tim, what are the opportunities there in Canada? What should our listeners think about?
Yeah,
Yeah, there's a lot. Go ahead, Brandon. Yeah, I mean, you should start, but there's a lot. So go ahead.
yeah. So I think number one, just given where we're at with certain developers that are maybe mid-size or syndicated equity, they're struggling just because there's a lower volume of sales activity. So there is opportunities to um, participate in lender-driven processes where you can pick sites up in urban locations that are in proximity to transit and really have solid fundamentals other than a challenged capital structure, and be able to capitalize on a bit of dislocation in the residential space for development. So stress has been, I think, a theme for the development space. We haven't seen it really in any meaningful scale at other sectors, such as office. Remains to be seen, what happens, with some of the refinancings and equity in, or whether there's, some gap capital that could be, supplied by family office or non-bank lenders to top up. But certainly, the stress in the residential market, and given the fundamentals in Canada around population growth, which we really didn't talk about, but it's probably worthwhile to mention that last 12 months, and this is 2023 number, Canada brought in 1 million immigrants, 400 which were permanent residents, and 600 which were not. Which, if you think about that, it's 2.5% of our population, and just the demand that creates, organically for, the needs for things that are in the built environment, right? Whether that's residential, whether that's, expanding logistics space for supply of goods, all the way through to the escalation of need for computing power, right? If you have more people using the grid, and using computers, not to mention obviously what we're seeing in AI. So the fundamentals are very good in that space. If you have conviction in demographics and convictions in supply demand kind of imbalance, which I think we're seeing a lot of the U.S. folks kind of take a pretty constructive view on. So stress and purpose-built residential, I think, are somewhat tied together, converting condo sites into, purpose-built residential sites, and still, generating, a return that, isn't opportunistic, but probably a good value add type of return from a risk return perspective. I think another thing we'll continue to see, we've seen a few, pretty significant public to private transactions in the listed space. One of your big private equity players just took private a single family rental player that also had multifamily. They were Canadian listed. We saw in 2023 a large industrial platform be taken private, largely backed by a sovereign wealth fund from the Asia Pacific region. So I think continued stake building, just relative to where discounts to NAV are, it would be a space to watch, particularly if the capital markets remain constrained in terms of raising secondary type of capital in the equity markets, or being able to do something in the unsecured space as well. And then we have underscaled asset sectors. So purpose-built student accommodation or student housing is a nationally branded asset class that a lot of folks participate, not only in the U.S. But certainly the U.K. as well. And there's just not that large institutional player brand building on a national scale, or even in major markets yet in Canada. But we are starting to see green shoots of that. And then I think to round it out, which is kind of correlated to the stress point, I mean, there's a big opportunity to play in the hybrid capital structure, whether that's mezzanine finance, whether that is providing a bit of hybrid equity that participates, and where that capital I think can come from is what we're seeing. At least there's a lot of interest from family office that have less kind of regulatory constraints than from some of the regulatory or Schedule A lenders here. And the rates of return on that are a lot of times better than the equity. And of course, you got to underrate how long that rate of return can continue, what the exit plan is for the asset. And the last point to Tim's point is real assets, right? So data centers are of high conviction here as well, just as it is in the U.S. Underpenetrated and underdeveloped here. Again, no large brand building. We are starting to see quite a few U.S. entrants come into the space, and the big quagmire there to solve is the power component. So the grids are similarly stretched in Canada, as I know they are in certain markets in the U.S. So what's going to be the solution? How to unlock that? Whether that's single micro reactors or something of that sort, or other renewable sources could be really interesting, and areas of high growth. So that would be kind of 5 or 6 that jump out to me.
And how would you classify the trends, economic trends for inflation, job market, consumer confidence there in Canada?
Yeah. So look, our monetary policy, interest rates right now, and I think we might get an interest rate decrease, tomorrow or certainly within the next, well, not certainly, we can't say certainly with interest rates, but the expectation from the market is, some movement there the next kind of 3 to 4 months. We're at a base rate level right now, 50 basis points kind of lower than the U.S. You guys, I think, are targeting somewhere in the range of 5.25 to 5.5, whereas we're at 5. So what does that drive? It drives development lending that floats here, and then from commercial real estate mortgage perspective, we run off 5 and 10 year Canadian bonds, and I think the 5-year today was 3.8. So you're looking at sub 6% money for good quality commercial real estate here. So certainly the monetary policy has a big impact, an outsized impact on the real estate space, and that could be a very interesting unlock to more deal activity and narrowing the bid-ask spread that continues to prevail. Inflation, we've I think we were 2.7% last month, and the U.S. might be a little higher than that. I feel like you guys still might be, based on last month's number, above 3%. But that's a good range for Canada to be in. That's within the 1 to 3% target range. We'd love to be at 2%, but hopefully that's providing the data to support some interest rate relief, which would really benefit the commercial sector and the residential sector quite candidly. And then unemployment, the U.S. and Canada have different ways of measuring unemployment. So I would just say that unemployment has ticked up from kind of 5%. I think we're at 6.1% right now. But I don't think you could kind of take that number, compare it, 1-to-1 with the U.S., which I think is probably 200 basis points lower than that. I mean, I think the headline there is that notwithstanding we've, just like you folks had this rapid rise in interest rates, and notwithstanding that, we're starting to see more flow-through impact from higher interest rates due to mortgages and how that impacts the residential consumer. We haven't seen that necessarily translate into significant unemployment, which is keeping the markets relatively more stable.
Tim, what would you add to that?
I think, look, when you talk to U.S. investors, when you talk to investors from Asia, when you talk to investors from the Middle East, Braiden mentioned Germany earlier in some of what he was going through. I think Canada is viewed as an economy that's doing well on a relative basis. There continues to be significant opportunities in residential related themes in the areas that Braiden mentioned. And, it's a market that has strong rule of law, and as we covered at the top of the podcast, the discussion on, title and how real estate is acquired and purchased. So look, I think it's a market that continues to be top of the list for investors, not just for here in the United States, but around the world.
Yeah. Well, Braiden, I'd like you to give us an answer to this question in your best Canadian accent, if you will. We're dying to hear the Canadian accent here. What would you leave our audience with to think about investing in real estate in Canada?
I think one, certainly from the U.S., I mean, we tended to historically seen U.S. names come in and out pretty quickly, and when they were in, they tend to come like buses. They were all here at once, and I think the change is a lot of them are setting up shop, and I think a lot of them are setting up shop due to a lot of those kind of core attractive fundamentals, largely in residential, but also logistics. And those factors are quite, unique. I mean, we didn't talk about it, but, Toronto has the highest number of cranes, I think, in all of North America at 233. The next largest city in North America, maybe it's just Canada, U.S., is Los Angeles with 50. So it just kind of gives you a bit of the scale of the development opportunity that's occurring here. So I think in summary, it's like one, attractive demographics, right? You have, highest G7 per capita population growth, and population growth is normally positive for real estate fundamentals. Two, you have, a supportive federal government providing meaningful support to the residential sector, which hasn't always been the case and has really been driven by an affordability crisis. Three, there's a lower prevalence of domestic capital, so there's actually a window of opportunity to step in and probably earn slightly higher octane returns than you could have historically. I think four, there's just underskilled asset classes here in general, particularly in the student housing space and data center space. So really those alternatives that maybe have received less institutional attention historically, we could be at a pretty interesting watershed moment here for those asset classes. And the last thing I think is, look, with challenged market conditions, if you're conviction led, can really lead to outsized performance. So it could be an excellent, vintage returning year when you put all those factors together.
Tim, final thoughts for us?
Keep a close eye on Canada. Both directions.
All right. And Braiden, give me some Canadian accent here. Finish.
Well, it's been a pleasure to meet you, and I really thought this was a helpful conversation. Hopefully, one of many more to come, because I think we are going to continue to see a lot more activity flowing both ways.
Hey, I like it. All right, gentlemen, thank you for being on the show. We appreciate it. Great information.
All right, take care. Thanks.
Thanks so much, Michael.
All right. Thanks for joining us around the country, and maybe you're listening in Canada. I hope so. So thanks for joining us. Hey, please share the show. Please contact us. Hey, if I can help you with anything, you have a question for me, reach out to me. I have an easy email. It's michael@bullrealty.com. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by CCIM C5 Summit. We'll be at the Hard Rock Hotel in Hollywood, Florida, September 17th to 19th. Visit c5summit.realestate. By CREI Summit. This will be in Atlanta, Georgia, September 11th to the 13th, right here in Atlanta, Georgia, where we're headquartered. Visit cresummit.com. By Bull Realty, commercial real estate sales, leasing, and advisory services. Visit bullrealty.com or reach out to me directly. My email is michael@bullrealty.com. By Commercial Agent Success Strategies, 21 cloud-accessed agent training videos. Learn more at commercialagentsuccess.com. You're invited to subscribe to the show wherever you listen or watch the show. You're also invited to subscribe to a weekly email announcing the show topic and guests at creshow.com. Thank you for watching, listening, and sharing America's Commercial Real Estate Show.